Hello, Mike Starks at Remax Town & Country here. Today I was wanting to do a quick little video blog concerning the upcoming 3.8% sales tax, which is going to start being implemented in 2013. I guess the first thing I should do, all my attorney friends would tell me, make sure you disclose. I'm not a real estate attorney, I'm not a CPA, and I sure wouldn't want to be one either. I just wanted to do this video because a lot of people are, probably at least once a month I'm getting an email or a telephone call now where somebody is, emailing me saying, hey Mike, if I sell my house next year, am I going to be hit with that 3.8% real estate tax? And anyway, there's just a lot of misinformation. I've been forwarded emails talking about how it's going to affect people. And really, I just want to clear up some of the misconceptions, I guess. So let me just show you some of how it's going to apply to people and how it's not. And also, there's kind of a misconception that it's a real estate tax. It's really more of a tax on investment income. And that's not to say I'm agreeing with it, because I think it's an awful idea. But anyway, let me just get to some of the details. All right, like I said, this really is not a real estate tax. This tax is imposed on the net investment income or the income in excess of threshold amounts, whichever is lower. And what that really means is that you're off the hook for this tax if you're a single person who's making less than $200,000 in adjusted gross income a year, or if you're married filing separately, your adjusted gross income could be up to $125,000 each. Or if you're married, filing jointly with an adjusted gross income of $250,000 or less, if any of those three apply, then this 3.8% tax is not going to be applicable to your situation at all. So unless you're making more than $250,000 as a couple or $200,000 as a single person, then this tax is not even going to be applicable to you. Also, even if you are making more than that amount, then the tax still is not necessarily going to apply to you. Again, this is a tax on your net investment gains. But for most people selling a home, it's not going to apply, because that same exemption that's been in place for a long time now, where if you have lived in the home as your primary residence for 2 of the last 5 years, and when you sell that house, your gain on the sale does not exceed $500,000 for a married couple filing jointly, or for $250,000 worth of gain for a single filer, well then there is no 3.8% tax rate on that. Because there's no capital gain tax on that. Now let's just also say, for example, that you are going to be in line for that tax. Let me give you an example here. Let's say a person earns $275,000 a year, so they're over that threshold. In addition, they sell a weekend home for, say, $300,000. They originally purchased it for $240,000, and they never lived in it or treated it as a primary residence. So here are the two calculations. The taxable gain on the home is $300,000, but you're going to subtract out that $240,000 that they paid for the home, because that's their base. So really the net gain is really just $60,000, and that's what that 3.8 is going to be taxed on, not the whole amount. So on that scenario, the 3.8 tax would come out to $2,280. All right. Well, I hope that helps clear up some of the details about this new coming tax. Who knows how it's actually going to play out by the time it gets here. Even if it happens to be repealed or parts of it repealed, I'm willing to bet you they leave some form of this in, whether it's for health care or what it be. There's an awfully big deficit, and I'm sure everybody there in Washington is going to figure a way to get it from you one way or the other. But anyway, I hope that clears up some of the confusion out there about it. And as always, thanks for watching.